where we're going to be focusing on investing 101, really kind of focusing on the basics of investing, but then also diving into some fun aspects and some actual takeaways that we could take moving forward. A little bit of background about me in case you haven't attended any of the events I've done before. My name is Brian Walsh. I lead our financial planning team here at SoFi. So really just gives me a unique perspective on the conversations that our planners are having with members. For those of you that don't know, members have complimentary access to our financial planners, so feel free to connect with them if you have any questions. And even though I am a certified financial planner, little disclaimer here, nothing I talk about today would be financial advice. Think of it more as high-level education, guidance. Definitely don't know enough about your circumstances. And really, there's no one-size-fits-all approach to personal finances, investing, whatever it may be. So you could talk to a planner one-on-one to get in those types of details. All right, cool. So I'm excited to just hop into the agenda today because I think we have a bunch of content to go through related to investing. Arguably, I think this is the one we're putting the most amount of content into because we get a ton of questions about investing on the weekly live streams that we do, the conversations one-on-one with members, you name it. People want to talk about investing. So I really want to break this into three kind of different sections. The first one would be, you may not think it has a direct impact on investing, but really the human element. Because I think so many times, we look at things, whether it be our past decisions or, projections or whatever it may be. And if you could take like the human element out of it, like it makes things super easy. But at the end of the day, we're not robots. So like, what are some things that could impact us as individuals as we're approaching investing? And then get into the basic concepts of investing to make sure that we're all on the same page with a, firm understanding of different types of investments, the trade-off between risk and return, things like that. And then, really ending it with actual takeaways to say, hey, here are some things that you may or may not want to consider as you're moving forward and kind of looking at your own personal finances and your own investment strategies and how you can do those different things along the way. So throughout today's session, have questions, throw them in the Q&A section. We'll get to questions at the end. Also, Paige will be sending out a recording with some links and everything tomorrow. So feel free to take a look at that. Awesome. So we'll begin started with, human behavior. And as we transition to each section, since we're doing this whole back to school, type approach to our personal finances, I thought it would be fun to start with, some random trivia or quiz, pop quiz type of questions. So why are we talking about human behavior? So I guess if you could just throw it in the chat, your answers A, B, C, or D, that would be awesome. So I guess question number one as we transition, over the last 20 years, how's the average investor done compared to the market? A, better, B, about the same, C, a little bit worse, and D, way worse. All right, we're seeing all different sorts of answers. Oh man, all right, we're seeing some bunch of B's and a bunch of C's, okay. That seems to be, the leader in the clubhouse right now. All right, so for all those that answered D, that was the correct answer. And the reason why I think it's very, very interesting to start with talking about the human elements and, and how basic behavior biases and things like that impact us is because I think just looking at the data, that's what ends up impacting so many investors. So if you look at over the course of the last 20 years, 1999 through 2019, and you look at the annualized returns, inflation was 2.2%. The S&P 500 was about 6.1%. The average investor got about 2.5%. So I don't know, I said D because I consider that way worse. So the moral of the story here is the average investor typically underperforms the market, whether it be comparing to the S&P 500 or other different benchmarks. And most of that underperformance comes from human behavior, making decisions based on emotion, buying when, the market's high, selling when it's low, changing their investment strategy, trading rather than investing, all those types of things that we're all tempted to do because of how we're wired up, up in our heads, impact our performance and ultimately our outcomes as investors. So this is really the driving factor on why we're starting the first section. I'm talking about some of the human behaviors to be aware of as we're making investing decisions, because I think if we're aware of them, maybe we can help identify them and say, hey, maybe I shouldn't be doing this. So we'll go through these at a high level before we hop into the investing basics. So I think the first thing that really catches people off guard a lot of times when they're looking at investing is how they respond to a loss in their investment account. When they see, especially I'd say this year has been unlike, I don't know, I guess you hear unprecedented all the time, and I'm kind of tired of hearing about it, but it really kind of has been, where we see a lot of volatility up and down in, throughout the stock market. And, at the end of the day, a lot of humans are naturally wired to be loss averse, which basically means that someone's going to feel more pain associated with, let's say, a $500 loss than the amount of joy that they would feel with a $500 gain. So a lot of times when people see the red and the green and things like that going on in their accounts, they tend to really react much more strongly to when their investments are going down than they do when their investments are going up that same amount. So I think one thing to keep in mind is taking a step back and taking that long-term perspective and knowing that that type of reaction is ultimately going to be natural. That type of discomfort and things along those lines is, as you see your accounts going up, going down, the natural part of investing. The next major factor that we see that's pretty common with individuals as they're investing is this thing called hindsight bias. And I got to tell you, this is probably one of the ones I'm most guilty of personally. And just naturally, I'm wired this way. I don't really have loss aversion, but I do tend to, take into consideration hindsight bias. So really, at the end of the day, hindsight bias is, some humans are naturally, they're wired to feel like they should have been able to connect unpredictable events when looking back. So I use these headlines as an example, even though they're a little bit dated. But like, if you go look back and you're like, oh man, there was these headlines about, recession signals flashing. I shouldn't have been able to know that the market was going to go down 20 or 30%, whatever it went down earlier in the year. Or in January, there's the headlines about coronavirus before it became, as big of a story and had as big of an impact on both human lives and people's investments as it did. So a lot of people are guilty of hindsight bias. And ultimately what that does is it makes them, kind of make assumptions as they're going forward in the future and read into things a little bit and kind of beat up on themselves a little bit. So this is definitely something that can impact investors. The third one that we see impact investors is confirmation bias. I think naturally, a lot of people seek out information that supports what they want to believe. I think you see this across the board. You can name it with pretty much anything, especially politics right now, investing, you name it. You could find headlines to support, damn near any belief that you have. And this is the perfect example of it. This was the same exact day from the same exact website saying, hey, it's the worst recession since the Great Depression is coming. And then the same day, it was like, hey, better than feared, earnings numbers, raising hopes. So it was kind of like, which one are you going to pay most attention to? And a lot of times you're going to be paying attention to the one that aligns with your beliefs, that's going to reinforce it. So it's really about taking a step back and kind of looking at everything holistically. And then finally, the last bias that we see kind of impact people as they're going through their investment journey is this thing called reference bias. So I think like what you compare investments to is really, really interesting because naturally, and I guess quick disclaimer, I'm a huge nerd when it comes to financial planning, so I read a lot of research, but it's really interesting because people are much more likely to sell winners and hold on to losers when it comes to investments. So they're much more likely statistically to sell stocks that have gone up since they bought them than they are to, hold on to sell stocks, and then they're more likely to hold on to stocks that have gone down since they bought them. So a lot of times that's because they kind of peg it to what they paid for the stock. So if they paid $300 for a stock and it's worth 100, in their mind it's still worth 300. So it kind of leads them to holding on to things. Not to say people it's a good decision or a bad decision to sell it, but just be aware that there is this bias that comes into play based on what you paid for an individual investment. that could come into play as you're deciding, like, hey, is this a good idea for me to keep holding it? And yes, this is a screenshot from my actual SoFi Invest account. I won't say the security, but as you can see, when I screenshot this, I bought the stock for like $370, and at the time it was worth like $155. So yeah, that was a short-term pain point for when I opened up the app from this security. Okay, so now that I think we have like just an awareness of some natural human tendencies that impact, how we look at investing, I think the next step is to start going through and saying, okay, let's look into making sure that we have a firm understanding of the basics of investing on different types of investments that are available, how the trade-off of risk or return works, and ultimately how different aspects of investing all work together so we can make educated and informed decisions. So going into this section, well, another pop quiz. This one's a little two-question action. So if you could throw, I guess, your first answer, second answer in the chat, that would be awesome. So the first one would be, in general, investments that are riskier tend to provide higher returns over time than investments with less risk. So if you think that's true, put A. If you think it's false, put in B. And then the second question is, buying a single company's stock usually provides a safer return than a stock mutual fund. Again, A is true, B is false. All right, we have the questions rolling in. The answers rolling in, not the questions rolling in. What am I saying? All right, cool. All right, so the right answers on that. So the first one is true. Investments that are riskier tend to provide higher returns over time than investments with less risk. Yes, and really we'll talk about this a little bit more in detail, but generally speaking, investing tends to be a trade-off of risk and return. It goes back to the idea of really there's no such thing as a free lunch. And then for the second question, the answer is false. Buying a single company stock does not provide safer return than a stock mutual fund. So we'll hit on both these things in more depth over the next, several minutes. There's a link down here in the bottom right. Again, I'm a nerd. This is actually a really cool quiz. I don't know, I like taking random quizzes. But it's actually like an investor knowledge quiz that's put out by, technically it's not the U.S. government, but it's related to the U.S. government, usfinancialcapability.org/quiz literacy. And it's like a 10-question quiz and tests you on different concepts and everything. It tells you where you got right, where you're wrong. And it provides some pretty cool perspective. For context, I think the numbers were like 40 or 45% of people answer, each one of these questions correctly. So this tends to serve as a good kind of barometer of baseline questions for, looking at the trade-offs of investing in the market. So as we get to looking at the basics of investing, I think it's always, interesting and important to start with the basics of different types of investment vehicles, because a lot of times we work with, members who, may be new to investing, and they hear all these terms get thrown out, like ETFs, mutual funds, stocks, bonds, yada, yada, yada. And they're like, man, I really don't know what these mean. So it's important to have a basic, understanding of the vehicles that you could utilize for different purposes, because like I said earlier, there's no one-size-fits-all approach related to personal finances or investing. And some of these vehicles could be good in some situations, they could be bad in some situations. So I guess we'll start with cash. And, cash, I guess, isn't always thought of as an investment, but, in a way, it's a place that you can allocate your money, or a place you could put your money. So like, we're going to consider an investment. Really, from a cash perspective, when we talk about cash, it could be, checking account, savings account, cash management account, certificate of deposit, money market account, all sorts of things that are kind of a cash or a cash equivalent. And really the function of cash and the benefits of cash are that it's liquid and it's going to be there when you need it. It's not subject to volatility of the stock market. So it can make, a ton of sense for, people for those purposes who are prioritizing that. The downside is if you look at, the long-term returns of cash, it tends to not even keep pace with inflation over the long term. So if you look at money that's going to be growing for a long, long period of time, let's say 10, 20, 30, 40 years, cash tends to be a very inefficient way to have that money sitting there because you would actually lose purchasing power since it doesn't keep up with inflation. Bonds, on the other hand, are another thing that's, another, basic aspect of investing vehicles, where essentially you are loaning someone money. It's kind of like, your friend's like, hey, can I borrow $100? And you're like, cool. They pay it back and maybe they pay you some interest. And that's essentially, bond is, you loaning someone money. So generally speaking, bonds tend to, historically earn a slightly higher rate of return over the long term than cash. They tend to, move up and down a little bit more than cash as well. But they typically are between, cash and stocks as far as how much, return they get and how much, up and down movement you get out of them. Third one would be stocks. So a stock is essentially where, you actually have an ownership share in an individual company. So you're investing in that company, and as that company grows, then, ideally, that would be how you would profit from that investment. So you would get money from, dividends or, the share price, things along those lines. Generally speaking, out of, these top three, stocks historically have had the highest long-term rate of return or the highest growth over a long period of time, but they've also had the highest fluctuations out of these three as well. So it ends up being, hey, long-term, historically, I've earned more money, but I've dealt with more ups and downs, so it might have made me a little bit more uncomfortable in the short term. These bottom two, mutual funds and ETFs, are really something that we see, honestly, on a regular basis. Mutual funds really can be made up of a mixture of cash, bonds, stock. They could be essentially you buy into a mutual fund and you get a proportional share of everything that the mutual fund invests in. So it could invest in 1,000 different companies or 5,000 different companies or whatever it may be. So it tends to be a really good place or benefit for people to who have let's say a smaller amount of money, $100, and they want access and exposure to a bunch of different things, and it gives them a little bit of leverage in that area. Typically managed by professionals. Downside is you're going to pay some costs with it, and there may be some tax ramifications that you don't have entirely control over. And then finally, ETFs, conceptually very, very similar to mutual funds. Probably the bigger difference is there's exceptions to both of these, but generally speaking, ETFs tend to mirror a set pool of investments or an index that you would see on on the news, like the S&P 500 or the NASDAQ, and it tends to follow that, and you typically don't have active decisions, and so we're managing it saying, hey, we're going to buy this because it's a good opportunity, sell this because it's not. And with that, ETFs tend to come with much lower expenses than mutual funds, but you still get exposure to a bunch of different investments with smaller dollar amounts. So there's pros and cons of investing in all these, and I think it's kind of working through that, but that would be high level, some of the reasons why you would, and we'll get into some of the more details later. So as I talked about earlier, and one of the questions alluded to, at the end of the day, investing really is a trade-off of risk and potential return. Anytime you invest in anything, there's always going to be the risk of loss. There's going to be volatility and ups and downs and things like that. Generally speaking, over the long term, the lower risk you're willing to take, the lower return that you're going to get. And then on the other side of things, the higher risk you're willing to take, the higher return that you could potentially get. And it really is that trade-off decision, because not everyone's comfortable with taking a large amount of risk. So, and when you take that risk, you want to be compensated for it. So that's an important concept to understand, because a lot of people are looking at this when they're getting into investing and building their strategy, and they kind of want the low risk and high return. And that really doesn't exist, historically over the long term, because again, there's no such thing as a free lunch. So I think it's important to understand that as you take more risk, then it typically is associated with more return, and vice versa. But at the end of the day, not all risk is created equal. A lot of times we talk about risk when it comes to investing. And I think, one of the things that most people overlook is, really what risk is and how we can overall develop a strategy in context of that. And I think it's really, really cool to me. So at the end of the day, at a high level, there's two different types of risk when it comes to investing. There's systemic risk, so like risk that impacts everything, if not everything, like a very large portion of the stock market. So some examples of that would be like political, the election going on right now, macroeconomic, so how the economy is growing, interest rates, inflation, currency. So risks that impact a very large group of companies or the entire market, that's systemic risk or systematic risk. Unsystematic risk is risk that impacts a much smaller group. So think of this as it impacts one particular company or maybe one particular group of companies that would be called, an industry. So it could be business risk, could be, related to the industry, it could be regulation, credit, country. I like to use the example of, I guess, a personal example of Boeing. So, Boeing, for example, was it a year, 2 years ago now, a while ago now. Seems like every day goes really, really long in pandemic. But so with the plane crashes related to the Boeing 787, that had a really big impact from a company's perspective on Boeing, and then it also had an impact on the airline industry in general. So that would be really looking at that as an unsystematic risk. Conversely, like let's look at like COVID, for example, that would be more of a systematic risk, where it impacts a much larger swath of things. So why does this matter? And that's what I want to get to. It really matters because I think there's things that you can do with unsystematic risk, but there's really not much you can do about systematic risk. And that's ultimately why it matters, because it builds the case and builds the justification for diversification. And I put together this image a while back, and I've kind of stuck with it. So if you look at it on the left-hand side, when you think about investing in an individual stock, and it could be any stock, you pick an example. And I'll use Boeing because I just use it as an example of unsystemic risk. So if you think about it, like it's going to have systematic risk. So if something impacts the entire economy, the entire world, it'll also impact this individual company. But it's also going to have country-specific risk, industry-specific risk related to airlines, business-specific risk related to, let's say, their planes and the performance of those planes, and credit-specific risk and their ability to manage their credit. So you kind of look at it, and it kind of layers up, and it starts adding up to when you invest in one single stock, you're exposed to these different types of risk. Now, let's say instead of being invested in one individual stock, you have some sort of diversification, which means you're kind of spreading it out into, several different stocks or a handful of different stocks. Ultimately, the value of diversification is you're still going to get that systematic risk. But as you can see, you start reducing the unsystematic risk by diversifying your investments and investing in more things. Now, that could, in theory, lower the risk, but it may lower the returns as well because you're taking less risk. And then finally, kind of like a hypothetical example, if you had full diversification where you invested in every single security in the world, you would still be subject to systematic risk. But in theory, you could diversify away all of the unsystematic risk. So a lot of times that ends up being the reason behind when people are talking about the value of diversification and the impact it can have and why people talk about it as a solid approach to people investing. And it really all has to do with the trade-off between risk and return and how much risk we're comfortable with taking. The final piece related to investing basics is, yes, it's important to understand the basic vehicles, the balance of risk and return, but then the final piece that I think is absolutely critical for people to consider is going to be the length of time that you're going to stay invested has a huge impact on, potentially how you should be investing that money. So I love this chart from JP Morgan, and they really kind of look at it at, I think it's like over 70 years. And it kind of looks at the range of returns over a 1-year period, a 5-year period, a 10-year period, and a 20-year period for stocks, bonds, and kind of like a blend. And really, if you look at that, over a 1-year period, the range of returns for the stock market, it went as low as negative 39% and as high as positive 47%. Whereas bonds had a much more narrow range of negative 8 to 43. Then you start going further out on the time horizon, and it starts to narrow. All the way down to long term, that range for stocks ends up narrowing from 6% to 17%. I think the moral of this story is, as you're looking at different reasons for investing, that should certainly impact the type of investments that you put your money into. A prime example of that would be, we've had members who've come to us that have their emergency fund invested in individual stocks that might be very, very popular. And we always advise against that because we don't know when we're going to need an emergency fund. And if we need it in a down market, then that's a very, very troubling position to be in. Or let's say a down payment on a house in a year. Typically, we would not want that invested in stocks. So it's important to consider how much risk you're comfortable with, but then also how long you're going to stay invested as you're going through and saying, hey, how should I pick this mix of stocks, bonds, cash, all these other things. Cool. So the third section, really going to dive into, how do we put this together and simplify it and not talk so much in the abstract anymore and figure out okay, what are some actionable steps that we can take and habits we can develop in order to, hopefully, improve our investing decisions. So we'll start off with another question. All right, we'll use the chat thingy again. If you invest 10 grand, assuming you earn 7% every single year, which, by the way, it's more fictional, how long would it take for your money to double? So you start with 10 grand, earn 7% every year. How long does it take to double? Is it A, about 5 years, B, about 8 years, C, about 10 years, or D, about 15 years? All right, we're seeing them roll in. All right. Awesome. Okay, so they're pretty much, I think like B or C, I don't know. That seems to be, we got a bunch of D's. Okay, but no one's really saying A. Okay, cool. The correct answer is C. So I mean, this is based on a rough rule of thumb, which would be the rule of 72. So essentially, if you have the return, let's say 7%, divide 72 by that return, and that's approximately how many years it would take your money to double. So that would be about 10 years. It's like 10 point something random. That's why about 10 years. And I think that's important context to have, because I think as we're looking to develop, healthy habits, we want to make sure that we have realistic expectations. We don't want to think that our money is going to double in 5 years and then get discouraged because it's not happening and then we don't stick with it. And it's helpful to think, high level, like, hey, how would, growth and, everything ultimately affect my investments, my portfolio over the long term? Cool. So I think the first habit and the first thing that people, should be thinking through, I know this is about investing. And I talk about this chart almost every time I talk to people. Making sure investing is right for you. I think investing is extremely important. In fact, I think investing is the only way that people can accomplish their long-term ambitions for the most part. But at the same time, it's also not what everyone should be focusing on. So if you don't have a proper emergency fund, if you have bad debt, generally speaking, focus on attacking those things before focusing on getting really, really aggressive, with investing, because those tend to be more foundational items of your personal finances. The emergency fund is really the buffer between an unexpected event and a financial disaster. Bad debt, anything with an interest rate over 7%, is very, very costly. The reason why we drew the line in the sand with the 7% is because that's the long-term historical return of the market. So if your interest rate's higher than that, then it would be more effective for you to pay down that debt as opposed to investing outside of taking advantage of your employer match, because that's free money. So step one, just make sure investing is right for you because it's not right for everyone. Assuming that's the case, then I think we move on to step number 2. And this may sound very, very obvious, but I think it's very, very important to take a step back and identify what your investment goals are and what you're saving for. And you figure out what you're saving for and when that's going to happen. Because we take a high level kind of like bucketing approach when it comes to when we're initially starting to develop an investment strategy. So if you're going to use that money in the next 0 to 3 years, so think about an emergency fund, down payment on a house in a year or two, stuff like that, then typically what we look at is, let's say, savings accounts or, cash management accounts, things like that. Mostly it's going to be cash and short-term bonds, because the priority with that 0 to 3 year bucket is going to be that the money is there when we need it. It's going to be accessible. We're not going to have penalties or fees, and we're going to have access to it. We don't want it to be moving up and down with the market, because what if the market's down 40% when we lose our job and we have to tap into our emergency fund, or we make the down payment on the house? So that 0 to 3 bucket tends to be, mostly cash and short-term bonds. Then if the goal happens in, let's say, 3 to 7 years, that tends to be honestly, that's the most challenging time period to plan for. Number one, not everyone has goals during the 3 to 7 year period. So if you don't feel bad. Not everyone does. Actually, right now, if I'm being honest with you, I don't have a goal that fits in the 3 to 7 year bucket. But if I did, that's really where we're trying to balance. It's a long enough period of time where we ideally want that money to grow, but it's a short enough period of time where we don't want to be too exposed to the ups and downs of the market, because, it can take markets a long period of time to recover. So that's typically where we see a mixture of stocks and bonds. Typically, we see this in brokerage accounts or maybe some other accounts, depending on what the goal is. And then finally, bucket 3, that's the long-term bucket. 7+ years, typically, probably the most common example of this is we see people saving for retirement. And when it comes to retirement, typically we care about the balance decades from now, not days from now. So our priority is going to be long-term historical growth. And that's typically going to be, historically, that's going to be investing in stocks, maybe some bonds, depending on how much risk you're comfortable with. So that's kind of a good baseline to keep in mind as you're taking a step back and saying, what am I saving for? When's it going to happen? And high level, this can kind of guide how I, could be investing my money. I think step number 3, and a hugely important habit, a lot of people hit on this in their responses when, Paige asked the question like, hey, if you could talk to, your younger self, what would you say? A lot of it was like, hey, I should have been investing early and often. And that's really, that tends to be the key to people's long-term investing. It's not picking, the hot stock and timing the market or anything like that. I mean, for the most part, the numbers show us that ends up working against people when they try to do that. But the most important thing tends to be starting early and making a habit. And I use this example, and you could adjust it for however you want to. But let's say if someone was 28 and they're making $75,000 a year, if they contributed 10% of their income every year and they earned a 7% rate of return, at 65, they'd have $1.2 million. If they waited 5 years, so they just waited from 28 to 33, they're like, hey, I'll take some vacations, whatever. They would only have $820,000 at 65. If they waited 10 years and now they're 38 and they start saving, they would have less than $600,000. So that 10 years delay ends up reducing the balance by more than half of what they've had at 65. So that means they'd have to save a lot more money in order to catch up, because when you delay savings, you're not missing out on the first 10 years of returns. You're missing out on the last 10 years, and really where you kind of get those hockey stick type of situation for compounding returns. So that's why it typically has such a big impact for people who start saving early and impact on people who don't save early. So as soon as you can make investing a habit, the better. And it's never too late to start. We get a lot of people who are like, I don't know. So I'm 34, and I have friends who like haven't started saving yet, and they're like bummed out. They're like, oh, I'm not going to retire. There's no point saving. I'm like, no. I'm like, if you wait another 5 years, you're going to be in a worse position than if you didn't start saving now or investing now. So it's about making investing a habit. As you're doing that, I think it's important to consider, where your money is going. Because I think, one of the silent killers that a lot of people tend to overlook when it comes to investing is going to be fees that they pay. So what I did was I used the same example and I said, hey, what if someone paid a 1% fee on their investments the entire time? They started saving at 28, that 1% fee would have cost them almost $250,000. So you look at the $1.2 million, not 1.2 anymore, it's like $950. So on paper, these fees all seem really small. 1%, 0.75%, 1.5%, whatever it may be. But these small numbers end up having a very, very big difference over a long period of time. So I think that's why it's important for people to be aware of, okay, I'm going to make investing a habit. I'm going to save the right way for my goals. But then also paying attention and making sure that we're not paying excessive fees and we're getting what we pay for when we're paying for fees. So I'm a huge advocate of trying to avoid fees, all else things being equal. Cool. So I know we went through a lot. Paige, I'll turn it over to you so you can pepper me with questions.
Awesome. Well, first want to just thank everybody for adding a bunch of really great questions during registration. We're getting a ton of really great questions now, so we're going to do our absolute best to try to get through every single one of them. But if we don't, just as a reminder, everybody gets access to meet with a certified financial planner like Brian, and we'll add the link shortly that you can do that. So just as a heads up in case we don't get to everything. So Brian, here is our first question. Number one, are ETFs a safe investment option during the pandemic?
Yeah, that's a good question. And to be honest with you, I won't ever say that any investment is a safe investment because, what I talked about earlier, there's always going to be a risk of loss or a risk of of it going down, up and down whenever you invest in anything. So I think people should be prepared for the fact that, investments can go up and down and there's risks to investing. But I think it is fair to say that, statistically ETFs would be safer than, theoretically just investing in one stock, going back to the example of diversification and different types of risk. So I think diversification is very, very important for investors, and ETFs can be a great way to achieve diversification.
Great. Okay, our next question. What is the difference between a CD and a bond?
Yeah, so typically I guess CDs are going to have bonds that have specific maturities too. CDs are typically going to be through a financial institution, whereas bonds, you can loan money to governments, companies, you name it. And typically speaking, depending on the credit risk of, the company that or the institution you're loaning money to, bonds may have a higher, interest rate than CDs. And ultimately, I think, CDs typically fit in kind of that cash or cash equivalent bucket, whereas bonds are in that different bucket because they typically have additional types of risks that CDs don't.
Great. And just a reminder, because I saw someone ask this in the chat, everybody is going to be getting a recording of today's webinar via email, so just be on the lookout for an email from me. Okay, moving on. What are investment options that have low to no fees?
Yeah, great question. So I think, some examples of this. Full disclosure, I work for SoFi, so take it with a grain of salt. But, for example, SoFi doesn't charge, trading commissions when buying or selling, stocks or ETFs, either full shares or fractional shares. So that's the type of fee that you could avoid. Typically also ETFs, tend to come with lower fees than, let's say, mutual funds. So that could be another way to look at fees and lower your fees. Also, there's, fees that come from paying someone to make investment decisions on your behalf, like working with a financial advisor that may charge 1% or 1.5%, and kind of paying attention to that versus, let's say, like a robo-advisor that doesn't charge fees or charges, very low fees. So I think on all different areas, there's ways to, avoid fees throughout the process by doing your homework. But to be honest with you, that's why I'm a big fan of companies like SoFi that tend to be very, very fee friendly.
Great. Okay, our next question. Do you think there's anything fundamentally different with the current stock market environment that would change advice based upon historical returns?
Yeah, that's a really good question. It's a loaded question. I guess loaded in a good way. It's awesome. Sure. I mean, have you ever experienced COVID-19 before? No, not that I'm aware of. At the same time, I tend to, and it's taken a long time for me to realize this as an individual, I tend to do the best that I possibly can to ignore the noise. Everything I talk about with the investing bucket and diversification and making it a habit are all things that I kind of practice. I have different buckets of money that are, set aside for different reasons. And then I kind of try to do my best to ignore everything else, the ups and downs in the market. I think there's certainly been short-term volatility. I think the interest rate environment that we're in is very, very interesting, if not, unprecedented. But at the same time, if you look at the overall American economy and the market itself has experienced, 2 world wars, a Great Depression, the 1918 pandemic, the Cold War, 9/11, the financial recession, all these crazy things have happened. And it's still kind of chugged along. So that tends to be why I use historical data, even though it doesn't predict future performance at all.
Great. Okay, so next question. Do you recommend dollar cost averaging or lump sum investing for the casual investor?
I guess the answer is C, all the above. I think both are awesome. At the end of the day, however people are going to get started investing and put money into the market and put money to work, if that's the thing that's suitable for them, I don't like pick one side of the argument over the other. Some people are quite frankly more comfortable with, dollar cost averaging. Some people are more comfortable with just putting it all to work. I think, studies have shown that when you have money available that should be invested, putting it to work when you have it available, whether that's right now or month to month, ends up being the best over the long term. I think the important thing is for people to invest in an intelligent way if that's the best use of their money.
All right, next question. This one, Brian, is related to the 3 different investing buckets, and it says, in regards to years 0 to 3, what exactly are savings goals? Kids, school, car, etc., or just the emergency fund?
Yeah, that's a great question. It could be any of those things. So I guess I'll use myself as an example because I don't share member details. So in my 0 to 3 bucket is my emergency fund. It is saving up money to pay for land that I want to ride 4-wheelers and snowmobiles on because I kind of like those types of things. And then related to my kids' school. So that tends to be in my 0 to 3 bucket. So typically we see stuff like that or maybe a home purchase in that 0 to 3 bucket.
Great. Okay. Is it too late for someone who is 65 to start investing?
No, I don't think it's ever too late. It certainly, starting to save at later ages makes it harder and it makes it more challenging. But I think the cool thing with investing is there's two benefits of saving. There's the obvious one where let's say you save $100 a month. That $100 a month, it grows into a certain amount of money when you want to use it. The other cool thing, the other benefit is if you're saving $100 a month, that's $100 a month you're not spending. So your lifestyle is now $100 a month cheaper, which means that you have to replace less money when you do want to start living off your investment. So I think waiting longer means you should probably save more. But I would always encourage people that it's never too late because of those two benefits.
Okay. Next question. What sites or sources do you use for financial education and research?
Yeah, so I mean, there's a bunch of different ways to consume financial news. Again, I work for SoFi, so this may be a little bit biased. I'm a big fan of the app. I follow, you know, I invest in stocks in the app, and I follow a bunch of companies, and it kind of curates the news in my member home feed in the SoFi app. I think that's pretty cool. SoFi Learn has a simple way to look at it. For more detailed research and kind of when I want to nerd out on things, then I tend to use, you know, like the Wall Street Journal, The Economist, or Morningstar to get into the weeds on particular topics.
Great. Okay, next question. How can I make at least $1,000 a month off stocks?
Yeah, good question. So I think, you know, at the end of the day, it's important to understand what phase of life you're in when it comes to investing. Because like, it's one thing to say, hey, I want to generate $1,000 worth of income from my investment. And if that's the case, then, you know, at a high level, I don't know, 12,000 times 25. I mean, you're probably looking at, you need to have like let's call it 400 grand in your investment portfolio. And you need to focus on generating income through, you know, dividends or interest or things like that. If you're talking about $1,000 worth of growth, then you would be focused on investing in companies that grow, and that's where you're caring about the growth. So I think it really is important to take a step back and think like, hey, is my purpose to generate income right now, or is it for my money to grow so I can generate income from my investments later on, and then pick and choose your investments accordingly?
All right, our next question just came in and it says, should I start investing while still in debt, credit cards, and student loans, even though I have an emergency savings in place?
Yeah, I think that's why, you know, we go back to our kind of financial planning framework. And we look at it as not all debt is created equal. I think there's good debt and there's bad debt. Good debt would be any sort of debt with an interest rate less than 7%. Bad debt would be anything with a great interest rate greater than 7%. And we typically always lump credit cards into the bad debt, even if it's like a 0% intro APR type thing. So, you know, typically credit cards, we would look at tackling those and paying those off before, you know, really heavily focusing on investing, because it would most likely give us the highest return on our next dollar.
Thanks, Brian. Okay, our next question. Who would benefit most from investing in an annuity instead of ETFs?
Yeah, good question. You know, I think going back to the whole point of, you know, every single, you know, thing in personal finances has pros and cons. The pros of annuities is, you know, it can create if you annuitize it, it can create a guaranteed income stream. The cons would be it typically comes with pretty hefty fees. So I would say someone who's focusing on growing their money, that may not be the best vehicle for them to use, but someone who is, you know, not very prone to taking on risk and wants guaranteed income, that could possibly be an approach to, you know, start getting income from their portfolio in retirement.
If we have 20% of income to either save or invest, do you recommend splitting that in half or focus on the savings goal first?
Yeah, great question. We get a question similar to this on a regular basis. So what we've seen work the best with members is to focus on one thing at a time and focus on the most important thing. The reason why we encourage members to focus on one thing at a time is because when people take the sprinkle approach, where maybe they take, you know, some money towards an emergency fund, some money towards investing, some money towards paying down debt, it becomes very, very easy to get discouraged because they don't see progress happening too quickly. And what we found is that progress leads to persistence, and persistence means people are accomplishing their goals over the long term. So that's why we tend to encourage people to focus on one thing at a time, and then use kind of like the checklist to say, okay, if I don't have an emergency fund, focus on that. Once that's tackled, then I move on to the next step, rather than focusing on a bunch of different things at the same time.
How do we know which stock to pick for the short term?
Yeah, so to be completely honest with you, I have zero clue what an individual stock or what the market or anything is going to do in the next 6, 12 months, 10 years, whatever it may be. I really think that investing is about the long term. It is not about the short term. And I think, study after study shows that when investors make short-term decisions and try to time the market, either through putting money in a hole for a certain period of time or trying to time individual stocks, it ends up hurting individual investors and really impacting their return rather than taking a long-term approach that's diversified.
Do you have any opinions on how cryptocurrencies factor into the types of investment buckets? Is it a type of investment that you include in your personal portfolio?
Yeah, I think at a high level, crypto ends up being one of those things where, number one, people need to be fully aware of the trade-off of risk and return. And they need to be fully comfortable with, the volatility that may or may not come with, crypto investments. Generally speaking, we kind of want to make sure that people have a solid financial foundation before, even exploring investments or, such as this, by having, their emergency fund, their bad debt paid off, saving, 15% towards traditional vehicles. And then after that, so, typically we don't want a, overly concentrated amount towards any individual stock or cryptocurrency, just to, balance, risk in a portfolio. That tends to be high level, my approach to cryptocurrencies.
Okay, Brian, you might have to go back a few slides here. What did you mean by protect income on the slide with the 8 items? Is that referring to insurance?
Yeah, Yeah, great question. So protect income, really step number 3. Yes, that's referring to insurance. Generally speaking, what we look at in this step is, number one, for everyone to have enough protection through insurance, where if they got sick or injured and they couldn't go to work, that they would still be able to make ends meet. And then for those people who have individuals that rely on their income, let's say I'll use myself as an example. I got 2 kids. That they have an appropriate amount of life insurance to protect their loved ones in case something happened to them. And we typically encourage people to do it in the most cost-effective way possible, so they don't have to spend too much money on insurance.
Okay, great. The next question is, what is the difference between the SoFi Select 500 ETF and the Vanguard S&P 500 ETF?
Yeah, so I guess, at a high level, I would direct people to the fund information that's online to look at the individual securities that are held in there. There will be a difference in the cost of each fund and a slight difference in the overall investment. The specifics, I'm not super familiar with the exact holding differences between the two, but there are slight deviations between the two ETFs.
Okay, when is it beneficial to move money out of a 401k into an IRA? Which is a better way to invest your retirement money?
Yeah, I guess which is the best way all depends on your circumstances. So I think generally speaking with old 401ks, people have several different options. They can leave it in an old 401k, they can move it to their new 401k, or they can move it to a traditional IRA. So I guess exploring, which one of those options is best for them, you should look at, hey, what are the investment options and what are the fees in my old 401k? Is that reasonable? What are the investment options and the fees in my new 401k? And then what would they be in an IRA? And then allow that to kind of guide your decision. And to be honest with you, some people want to take a more hands-on approach and like the opportunities they have to invest in an IRA because they can pick and choose that. But at the same time, you should consider, all 3 options as viable alternatives.
Okay. What is the difference in a safety net and an emergency fund?
Yeah, I guess the only difference is size. So a safety net is 1 month's worth of expenses. Kind of think of that as like the bare bones and the basic foundational aspect of your personal finances. Like everyone needs to have 1 month's worth of expenses set aside in cash. And then eventually we want to grow that to an emergency fund that's 3 to 6 months worth of expenses, but there could be some other more pressing things in between those two, such as taking advantage of an employer match, protecting your income, or paying off bad debt that, you may want to, take priority over building that emergency fund up all the way up to the 3 to 6 months worth of expenses.
All right, I think we have about time for maybe 1 or 2 more questions. What is a decent amount of money to begin investing and trading stocks with, and what is the best platform to use?
Yeah, so the right amount of money, to be honest with you, I think, I think if investing is right for individuals based on, everything else they have going on in their finances, then I think getting started as soon as possible, and, no amount's too small. I think you can start investing with like $1 or $10 or whatever it may be. And I think it starts to build, and you start creating a habit. And then once you create that habit, you can, build upon that habit. So I think the best investing platform, again, there's no best or worst for anything personal finances. I think SoFi offers, fractional shares and, stocks and ETFs without trading fees. They also offer automated investing without advisory fees. I think that could be very beneficial. But I think it's ultimately up to the individual on what they want out of an investing platform.
All right, let's wrap it up here with the last question. Can I put all of my savings into stocks?
Can and should, I think, are 2 different answers or 2 different options here. Yes, of course you can. Generally speaking, we would advise against someone doing that because we really, really support the importance of an emergency fund for not only financial reasons, but emotional reasons. Emotionally, that having a cash cushion to handle the unexpected has the biggest impact on financial satisfaction and financial anxiety. And it also kind of serves as the buffer between unexpected and really, really bad financial outcomes. So I think it's important to have an emergency fund and not put all of that in the stock market.
Thanks, Brian.
Cool. So thank you everyone for attending. I guess before we hop off, again, you can talk to a financial planner to go through your specifics at SoFi.com/SoFinancial. You can also explore SoFi Invest if you want to start investing using SoFi at SoFi.com/invest.